What are my three key charts on the job market right now? Hi, I'm Jeffrey Roach, Chief Economist for LPL Financial, and in this edition of the Econ Market Minute, I want to share three of my top charts on the labor market and what it means for businesses and markets and the Fed. So first, after many months of wages rising and making investors nervous about any potential wage price spiral, wage growth in December decelerated to 4.6%, the slowest since the summer of 2021. Slower nominal wage growth should ease inflationary pressures from a tight labor market. You'll notice that the trajectory of the consumer price index follows the movement in average hourly earnings. So this is important for investor expectations about Federal Reserve policy later this year. By the way, if you drill down into the details, you'll see earnings particularly softening in the retail and transportation sectors. One of the sticky portions of inflation is within the services side of the economy, so we think that even these categories will soften further throughout this year. Well, the second chart to highlight is the monthly job gains in this country. Average job growth over the last 6 months is roughly 300,000. Yes, a far cry from the average gain just 12 months ago, yet still running too hot for a central bank trying to cool down consumer demand. When an economy has this amount of steady job gains over a sustained period, you could make that argument for a soft landing. And what's even more noteworthy is the employment to population ratio is now very close to pre-pandemic levels for those in their prime working years. And that means those that are aged 25 to 54-year-olds. So the bottom line here is that this job market is healthy enough to keep those soft landing scenarios as part of the discussion. My third pick for this podcast is the chart foreshadowing a coming change in labor market churn. That is the movement of workers from one job to another. So first, if we learned anything over the past year, we learned that real insights are gleaned when we look under the headline numbers and into the details. So take quarterly GDP, for example. The headline was negative for 2 consecutive quarters in 2022. But a few underlying categories were quite solid, telling a very different story. Take inflation as another example. Goods prices started falling before services prices. In this case, I want to highlight the churn in construction workers. So these workers are not leaving their jobs like they were just several months ago. And by the way, I'm showing here what we call the quits rate for the economy as a whole and the quits rate for the construction workers. Now, the reason I called out the construction space was because we knew that firms were having particularly difficult times hiring qualified workers in the construction space because workers were hopping around from firm to firm, trying to chase higher pay or employment in a different location. So perhaps fewer workers are quitting because those workers are less optimistic about the chances of getting a better job. So if the construction space is experiencing less churn as the market becomes less tight there, then this is certainly good news for the labor market as a whole. Well, that's all for now. Continue to follow me and the LPL research team on social media, and take care.